Sure you will. So it's lovely to see you. It's lovely that you're here, thank goodness. I was going to have to be split personality, I thought, at one point then. So before we get into the questions, I'm going to be asking Andy lots of questions that I've got. I think what worked really well in the session before was the audience participation. Slido is the future, obviously. I've never seen so many questions, so please keep feeding them in. I've got 2 iPads, so I might get the wrong question, but I'm sure we'll be okay.
Nothing too awkward.
No, nothing too awkward.
Yeah, we'll see.
As awkward as you can, please. Andy's good. Okay, so do you want to do a quick intro first?
Yeah, sure.
Andy?
Hi. So I look after, in Lloyds Banking Group, I look after strategic partnerships effectively. So the national account team in both mortgages and housing. And that means we look after kind of strategic partnerships with the big mortgage distribution networks and clubs. On the one hand, so we do things like, alignment of strategy, tech integration, all of that kind of business to business stuff. And on the other side, it's the housing side. So as you know, probably we're the biggest lender to the new build sector. We have a really positive working relationship with the top 20 UK builders and beyond, and also get involved in quite a bit of kind of housing strategy with government and Homes England. So it's a really interesting job actually to triangulate the housing world with the mortgage world, with the world of lending.
Brilliant. Thank you for that. So shall we start? Shall we start with the first question? So we split it into roughly three sections really. So what's happened this year before the mini budget and after the mini budget. We're then going to look at what we're thinking about in 2023, and ever the optimist, where are the opportunities for 2023?
Sure.
Okay, let's start then. So, my first question to you, Andy. Let's talk about the mortgage market. So, a big old question to kick this off. Let's talk about the mortgage market so far this year.
Yeah.
As I've just said, it feels like there's a pre-mini budget environment and a post-mini budget chapter.
Yeah.
So, how with the lender? How have you found it?
It's difficult to know where to start in it. So, I'd say there's definitely a PT theme, which is a pre-trustonomics and post-trustonomics, without a doubt, because flipping heck.
Yes.
But I'm going to go back a little bit further, if that's all right, because I think
this
sort of starts if you go back to the early days of COVID, and on reflection, who'd have thought that the housing market would go through the phenomenal time that we've all been a part of delivering from the start of COVID. And towards the back end of 2020, we had house prices booming, we had the race for space, the market was incredibly active. And I think 2021 was the biggest mortgage market we've ever seen, frankly. However, through that period, thinking about towards the back end of 2021, there were already some kind of issues emerging economically. So Brexit and, to an extent, Brexit and coronavirus had started to create supply chain problems. So things like labour costs were much higher than they have been in the past. Things like the cost of goods and services, in particular in house building, had pretty much gone through the roof by that time. And there was already kind of the spectre of high levels of inflation starting to emerge at the back end of last year. So we were hearing up to double figures on inflation, which was starting to cause nervousness. But then we had the terrible events in Ukraine at the start of this year, which then absolutely compounded those problems. And then you threw into the mix energy inflation, energy price increases. So we had a really high inflation forecast, and really actual inflation was really high. No, we've not seen plus 10% inflation, I don't think, for many, many years. A lot of us probably never seen it. So that inevitably led to interest rate rises. And the story this year is kind of about interest rates, but actually it's probably more about mortgage pricing. And mortgage pricing is more linked to swap rates. Which is kind of like a raw ingredient of mortgages. The way you price your mortgages is you look at the cost of swaps for a 2-year or a 5-year deal, and that's where you need to price your mortgages. So about 12 months ago, swap rates in the market, and you can Google this, just Google SONIA swap rates, because it's all publicly available information. So about a year ago, swap rates were 50 to 70 bips for a 2-year deal. So that's why you could price mortgages at the rates that people are rolling off now, 2 to 2.5%. They'd already started to creep up as interest rates rose this year, so they were creeping up to the sort of 200, 300 levels. And just before the mini budget, or whatever we call it, we do call it the mini budget, though, politely. Just before the mini budget, the two-year swaps were at about 400. So they'd gone from like 50 to 70 bips, 0.7%, all the way up to 4%. So we'd already seen the kind of fairly rapid increase in mortgage market pricing. However, on the day of that event, swap rates jumped from 400 for a 2-year deal to 580. So a massive increase of nearly 2% in one day. So from a lender perspective, that meant when you came in on Monday, literally all of your products, if you ran out of the hedge, you buy money in tranches, all of your products had to be priced up by nearly 2% almost immediately. Otherwise, you were slowing things underwater.
And just on that point, Andy, is that unprecedented? Is that something that you don't see, obviously, every day, every year?
I mean, so I've only been in mortgages for say 10 years. I've never seen anything like it. Yeah. If you think about it, we went through a very lower for longer interest rate kind of environment, and we've all got used to that kind of very cheap mortgages, very low interest rates, very low movements in pricing. But this has created a rapid, and you've all experienced it, it's been horrendous for all of us, frankly. How you've kept up with the pricing in the market, I really don't know. But like literally on that Monday, well, you saw what we did. We said we're going to simplify our range. We'll take out our fee-based fixed rates. Unfortunately, that got mistranslated on the BBC, basically. And the headline was Halifax withdraw their fixed rate mortgages, which was like chaotic. And then Chinese whispers, Halifax are withdrawing offers, which we didn't do either of those two things. But I think that spooked the market to an extent. And we saw lots of lenders kind of retracting in that early, the first day post the budget. And you went from something like 4,500 products in the market down to something more like 2,000. Yeah. And some lenders were just not participating. So from a broker perspective, I can only imagine it was tough enough keeping up with the price changes before those 2 weeks. But then literally lenders were pricing in the space of every almost an hour's notice. Some people were pricing, and that's how big a deal it was to have products that were out there that were so much underwater because the swap rates had gone up so quickly. I wouldn't say it was panic, but it was having to move very, very fast for very, very important reasons from a sort of P&L perspective. And we, even through that period, I mean, we tried to be as fair as we can. Halifax, we tried to give as much notice as we possibly can. There was a point when, for 2 weeks, we'd actually had the biggest weeks lending in history that we've done, more than ever. But we had to create some space for servicing. So we ended up, and you'll remember this, there was a Friday afternoon when we were debating, we've simply got to clear some space for the weekend to let our people process the business. And we ended up with a very late withdrawal on a Friday afternoon, and we're sorry about that, but it was a needs must. We don't like to do that. It's not kind of the Halifax or the Lloyds Banking Group way. But it just shows how important it was because our service was maxed out effectively.
And obviously it could be too much of a sensitive question, but what sort of volumes were you seeing in multiplications against, I suppose, your average?
Well, I'll not say exactly, but in terms of historic context, the biggest week prior to that was about, well, the bigger week was 140 to 150% as big as that, and we had 2 weeks back to back that were bigger than anything that we've ever done. So it just stretched, literally the whole market, it was stretching everybody's service to the max through that period.
And I'll just use that magic one question for now. So we're 5 weeks further on. If you got that magic wand and you look back retrospectively, as a lender, would you have done anything different that would help the brokers, that would help the end customer? Or was it just a survival mode?
It's really tough, Claire, to be honest, because who'd have thought it would happen? Nobody was planning for this. Nobody expected that kind of rapid increase. I mean, as much as possible, we would try not to get into a situation where we gave literally no notice. But that was a bit of a function of the market, and we were sort of worried because we're so big. We were taking a lot of the market share at that point, so bigger market shares than we've probably seen historically, pretty much ever. But we have to be really careful because if we pulled out, it's kind of like who can plug that gap. So we needed to make very careful moves. And I guess the good news is we've kind of got through that period now, and it looks like Jeremy Hunt came in, they revisited lots of the assumptions in the mini budget, they sort of said this is how you fund some sensible changes. And what's happened is the swap rates that were 580 that I mentioned, they were kind of up and down for 2 weeks, but they've more or less stabilised now. For a 2-year deal, I think they're about 4.4%. So it's still high, it's still high in the long-term context, but at least we're not seeing them fluctuating on a daily basis by 50, 60, 70 bips, which creates all the crazy pricing activity in the market.
Yeah.
So, I mean, fingers crossed. Let's hope that, you know, we've got the budget on the 17th of November.
Yes.
Let's hope that that increases more stability, and you might start to see now a market that's stabilised, more people are participating, and maybe even more people are competing. So prices might come down a little bit.
Yeah.
Fingers crossed. No promises, but you know, that's what you might see in a normal competitive market.
So just staying on that subject then for a second or two, we know Bank of England meet tomorrow, and there's a forecast. I think we'd all be the most surprised.
More vodka.
Yeah, there's definitely a forecast a rise tomorrow, isn't there? There's debate whether that's 75 points or it goes up by the full one. How do you think that will affect the pricing that's out there at the moment? Have lenders already forward price that in, or do you expect there to be another big shuffle again?
Because it's more about swap rates, fixed rates are more about where people think interest rates are going to go. This has been fairly well signalled, I think. So if it goes up 75 bips tomorrow, I don't think anyone will be surprised, frankly.
No.
So that probably means that swap rates will remain fairly stable, because they're already predicting out to 2 years and 5 years that interest rates might go as high as, you know, let's say 4% in future years. So this is all about creating stability and predictability, I think. I think it's fairly predictable that interest rates will rise tomorrow. The question is it 0.75, 0.5 or 1?
Yes.
You know.
Okay. So we've touched on this briefly in my opening address this morning around mental health and well-being. And that's apparently been high on the agenda, every business agenda since the start of the pandemic. It's a serious issue. It's a massive, serious issue. And this is not just aimed at LBG, but to the industry as a whole. You could be, as a broker, it could be not too unreasonable to think that that's all gone by the by. Poor communication, quick pulls, Sunday evening, Friday nights, then the lenders aren't there to speak to the clients. How do we make that better going forward? For me, it's a real serious issue.
I totally agree. And you know, it's everywhere. It's not so very definitely out there in your world. It must be incredibly stressful. Back in there, I talked about a servicing team. So flat out on overtime, flat out on weekend working. It's everywhere. And I think we've done so well actually at, you know, getting through COVID, where we had to change our operating models. We had to get people working from home. That was particularly stressful for some people and difficult. I think we've done a really good job. And, you know, be interested in any feedback. It felt like we'd really adapted to a new way of working and a sensible way of working and a more balanced way of working actually, which was quite nice. But then this happened, you know, and I think if anything, it kind of started, didn't it, when swap rates started to go up earlier this year?
It definitely was. It was there before the mini budget. It was definitely there before the mini budget.
And so I mean, it's about this predictability and fairness, I think, for me. So I think lenders haven't been used to putting prices up as quickly, frankly, for many years. But I think there's good practice and bad practice there, you know, and I think good practice is, you know, considering the timing of when we have to make these changes, considering of the impacts that then has on you and then on your customers, because we've got to think of customers. It's really stressful as well at this point, and we've got to try, I think, get back to some kind of normality on that kind of pre-planning and pre-notification process. But it is difficult, and the reason it's difficult in volatile markets is when you send a notice out to say we're changing prices, you get your biggest day that you ever have, because it all comes in on that day. So, and that's why I think lenders are really careful about the amount of notice that they give based on the state of their service at that point in time. Because sometimes you can ill afford to get another, you know, biggest day that you've ever had in history that you have to process on top of the problems that you've got already. So, you know, I think as lenders, the lender population truly do get that we cause problems, and we really don't want to do that. Not least of which because we rely on lots of goodwill. We rely on you working with us. We rely on a positive working relationship, you know, because that's how we all benefit, frankly.
Definitely, because some lenders do it so well, don't they? We could all call out a couple of lenders that you read through LinkedIn, you talk to brokers, you call out those lenders that consistently do that. So the blueprint's there, isn't it? I suppose it's moving on. It's moving, it's learning, isn't it, and getting better, and hopefully never going through this again. And but never say never.
Well, I mean, hopefully not. I mean, it's unprecedented, really. But feedback's important, and you know, I'll mention our PT product.
Please do, Andy. Yeah, that would be great. Thank you.
Feedback is really, really important. So you look. Have you seen the 3-year PT?
Got one yesterday.
A few people have. Okay, right. So the story behind this is a really positive story, because this was all about trying to help people who are going to experience payment shock.
Yes.
And we had to quickly implement something. We were sort of talking to government about the help we're given as well. So we quickly needed to implement something to say this is how Lloyds Banking Group are going to help those people with massive payment shock. Unfortunately, in the translation through the pricing process and the implementation back in the shop, it missed the point. And I think it created problems in the broker space, because we had a direct product available that was visible to people who qualified through certain criteria. And two things happened. So number one, it wasn't available in the broker market, big problem for me and for you. Number two, the criteria was too broad. So too many customers of yours could qualify for that product, which inevitably creates conflict. And feedback's really important. We got so much feedback, understandably, from the market, which was very predictable, that actually you'll see yesterday, we've now done something different on that 3-year product. So we have a 3-year product available now for PTs across all distribution channels. And it's again well priced. So, you know, we've kind of listened.
Fantastic.
And the ideal solution for us is really to focus on those people that are genuinely suffering financial difficulty. But the good interim step is everybody can have access to that product. But that's where feedback's really important. So when you are bumping into things that really affect your lives, make it clear. You know, feedback to the lenders. We want to listen. We want to do things better.
And as a club, Andy, we fed quite strongly
Absolutely,
our opinion back to you, didn't we? We understood the reasoning behind it, but we also know that we've got a team, a market full of advisors that have always supported you guys. But the conversation was definitely there, wasn't it?
It was.
Between ourselves.
Yeah.
Okay, so let's move on to next year. Let's talk about new builds, shall we, for a while. So how would you feel that the new build sector is going to be affected by everything? So Help to Buy and all of that good stuff. 19 housing ministers in 19 years, I think, is the...
Politics.
Sure. So there's a little consistency. So how do you feel about new build?
So first of all, I'd say new builders have had a great time over the past 2 years. They basically haven't been able to build fast enough. And if you think about sales next year, they're forward sold probably for 9 months. So they're already kind of looking at next year thinking, we've got a pretty good year under our belts. Yeah. The headwinds, though, are obvious. So the headwinds are probably less about Help to Buy, because interestingly, I think the move to the regional caps made the builders think carefully about the stock that the future stock they were building. And they're used to operating, I think, at these kind of lower LTV levels. And actually, you know, Help to Buy's pretty much dropped off since halfway through this year because of the build profile of the builders. So I don't think Help to Buy is going to be absolutely massive to the market. We are talking to government, though, about other things that might help first-time buyers, which might be worth coming back to. The thing for next year, I guess, is the cost of living crisis. And it's you know, what I'm hearing today is that there's lots of people still going to new build sites because it's very attractive buying a new home, especially when your energy bills are 500 quid in a second-hand one. It's a great purchase, isn't it? You would move into a new build. But I'm hearing more and more people are sort of turning up to the site saying, I quite fancy that house, going through the mortgage qualification, realising it's like 5.5% to 6% mortgage, and going, I don't quite want to commit just yet.
Not yet.
So reservations are sort of slowing up a little bit, and I think people are just pausing and reflecting.
Yeah, I'd agree.
So I think it'll be a bit slower for new build next year, although their forward sales position means that they've probably got a bit of a gap headroom wise to say, you know, how do we think about H2 next year?
Yeah, brilliant, thank you. And what about buy-to-let? Is that going to be more of a challenge, do you think, in 2023?
Yeah, any buy-to-let specific brokers in here? Anybody? It's difficult. I nearly used the word carnage. So the market has plummeted, frankly, and it's because it's the first time since the PRA stress rate implementation, which I think was in 2016. The market's never worked in a high interest rate environment.
No.
So what we're finding is the stress rates on the rental payments today are just resulting in loan sizes where you need a 50% plus deposit. So the market's taken a real hit. And I don't know what will fix it, actually. So, I mean, sadly, I think it might drive rents up a little bit, which is not really a great outcome. But it might also drive some product innovation to say, how can we, change, how can we keep the doors open effectively on higher loan to value in the buy-to-let market? But I think a lot of lenders are really getting stuck into that. How do we fix this? Open to good ideas, frankly. So let's answer on a postcard.
Brilliant, thank you. So let's talk about customers. They're likely to feel a change in repayments, aren't they? If you're coming to your end of your deal, we know it's a big year, we know it's the biggest year in history, 1.8 million customers coming to the end of the deal. Average fixed rates, they're coming off around 2.5%. What could they go up to, let's say in between 4 and 6%,
I think so.
to be broad? We could start to see people really struggling to pay the mortgage, couldn't we? And vulnerable customers, we know, has been at the heart of the FCA strategy. Absolutely right. That's therefore is embedded through lenders. How will we look after these customers? Will repossession, etc., be a last resort, do you think?
Well, completely to that last point. And I know all lenders will have their own version of this, but I'll talk from a Lloyds Banking Group perspective. So we're being really proactive. I mean, it's a big concern, isn't it? People haven't had these sorts of bills and increases for years and years. And the other worry is, I think, through COVID, maybe people did take that step up into a bigger property on a low rate because stamp duty helped them. So there'd be quite a lot of people potentially really experiencing big mortgage uplifts as well. So we've got a big team actually in the bank that's specifically about customers in financial difficulty. And the obvious reactive stuff is when we see a problem. So we'll do things like the three-year PT product that might be helpful. But then when people start to experience difficulty, please get them to contact us because we'll take very bespoke plans and actions to help people, try and help people through difficult patches. And to your point, repossession is for people that want to work with us and talk to us and operate a plan. It's a long way in the future where we get to the point of saying we've had enough, we're going to repossess. We try our very hardest not to do that. So that I think, and every lender will have that version of that. So encourage people to talk to lenders when they're experiencing problems. We're also trying to be more proactive though, because we've got all this data about car loans and credit cards and overdrafts, and you can start to use that data to say it looks like this chunk of people over here are already starting to get themselves into trouble. So we're trying a bit more of a proactive approach to say how do you reach out to those people and have a proactive conversation about the things that might be able to help them from mortgage or other ways of dealing with those problems. But it's going to be a tough problem. I think the honest thing is we all need to be conscious of it and help people as much as possible. Be open to conversations about these problems.
Do you think the regulation that came in on the back of MMR around affordability and stress testing and all of that, do you think that should help to safeguard against that? I know we never expected everything to go up so much, so it's
exactly.
It's still something that we wouldn't have had, isn't it? 10 years ago?
I can't remember exactly when it came in, but it was in when I started in mortgages. But
2014,
definitely.
I think.
I think you're right. Absolutely. And it's interesting, isn't it, that we've all been pushing to say the stress rate's too high, and the PRA have said, well, actually, you don't need to do SVR plus 3 now, you can do SVR plus 1. But it's a bit of a lesson in life, isn't it? That if we hadn't had that in, previous years, people might not have had that headroom to be able to absorb some of those higher interest rate costs. Because the calculation, as you know, is SVR plus 3. So you're probably talking about people 2 or 3 years ago being stressed at, let's say, 6 to 6.5%. So at least theoretically, they've got a bit of headroom that's been baked into the affordability calculations. It'll be interesting to see how lenders react now, though, when potentially you're stressing people at 9% or maybe even 10% post base rate increases. So there might be a point when we start to say, have we not reached the peak here? So that's where the 3% calculation might be a bit more flexible, I think.
Just a quick question on the same point that's coming from the audience. Do you think that the mortgage market review Boris Johnson said he'd do earlier this year will actually happen?
Probably is the honest answer. And funny enough, somebody was talking to Treasury this week. They didn't give a firm answer, but I think it's still. And bearing in mind, it was Michael Gove that kind of was in the chair when this was being thought about, and he's very much a man of action. regardless of what you think about his politics, he gets stuff done. I think my prediction will be yes, it will happen, and it needs to happen.
Brilliant. So it feels like lenders are tightening affordability. Again, anecdotal feedback to me via the brokers that I talk to. So we know the cost of living, higher rates, must affect on how much a new borrower can borrow. How much of an impact do you think that's going to have on loan amounts? Particularly, first-time buyers is a real good example there. Could it affect them more than ever?
Well, it can. I mean, if you combine the stress rate together with, it's an interesting case study, because I was looking at some of our affordability last week, and I think what we've done is we've applied the full 3% stress rate. We've added a bit for energy bills. We've added a bit for, all the cost of living stuff. We've built a buffer in for people at the top, and before you know it, you suddenly you can reduce the overall lending amount substantially. And I think it's a sensible thing to do, but then you need to consider the layering effect of all of these different changes that you make. So it will inevitably have an impact on total lending. It's the right thing to do, I think. But
how transparent do you think lenders will be with brokers on that? Because it's important that they understand that, and I suppose they're talking to Mr. and Mrs. Smith, aren't they? They're the ones that are dealing with the Mr. and Mrs. Smith visiting the new build property and can't afford it. So it's good to manage expectations, I would imagine.
I think reasonably transparent, but we will never be totally transparent, because that's a bit of our trade secrets, our crown jewels, our credit risk mechanisms. So we would talk about things like we're building more in for energy bills, because it's obvious, isn't it? Why wouldn't you do that if energy bills have doubled or trebled? You would probably talk about the impact of the 3% stress rate in a higher, SVR environment. So that's the obvious stuff. But then behind the scenes, you kind of got to trust us to say that we are making the right moves to protect us and the customer.
Yes.
But sometimes we go too far, and maybe I think there's parts of our book today that we've gone a little bit too far with. So that's an interesting internal conversation, let's say, with our risk teams.
I can imagine, yes. So I've talked about being ever the optimist. So every cloud has to have a silver lining, doesn't it? What the silver lining is going to be next year, Andy? $1 million question.
Blimey, silver linings. It's a difficult one, but first of all, customers will really need advice. They'll really need your help.
Totally.
They'll probably have never need it more than this period to help people get through. So from a you and your customers that you look after, the positive will be that you can help them. You really can help them and listen to them, help them through this tough period. Where else would I go? So I think beyond that, hopefully a period of stability should come back into the market. And let's hope that the swaps do stabilise around this kind of mark. Because in the overall long-term context, mortgage rates of kind of 4%, 3, 4, 5% are not massively high. So I think properties are still affordable.
Yes.
It's just that people need to get their heads around it. It's easier, I guess, if you're just buying brand new as opposed to product transferring or remortgaging. But I think the market, people will adjust. And like I said before, there is affordability buffers built already into the system. So we're hoping that people can get through this period, because I think there's still demand. I think the race for space post-COVID. I think people are still thinking about that. I think people are still thinking about energy bills and can I get something that's much more efficient than the house I've got today? My old Victorian terrace is about 450 quid a month, and I was in a new build house last week where they said the bills here are 200 quid, and I thought that's good, and then they said per annum. And it was like holy, that's kind of life changing if you think about it. So I think there's lots of positives there, and I do think longer term. So I think house prices will probably, we can't keep going at 10% per annum, can we? We can't do that. So I think house prices may struggle a little bit next year, may decline a little bit. But if you put that in the context of pre-COVID to the end of next year, you'll still see house prices probably up at 15 to 20% over that period. And I think we'd have all taken that. But I do think next year is probably a bit of a pause and reflect especially on people kind of really stretching themselves with these new bills. But fundamentally, I think I think the housing market, and I think it will still be a pretty big mortgage market next year.
Great. Good. I'm glad to hear that. Really glad to hear that. So we're coming to the end of our time. Loads of questions. We knew we'd never get through them all, didn't we?
But difficult ones.
Yeah, well, that's because you were late, Andy. So let me end on a final question, and it was a question that Abby posed to the lenders before around the magic wand, but I'm going to ask you slightly differently. If you had got a magic wand to make the brokers' lives easier, what would you wave it at?
That's a really awkward question.
Yeah,
that.
sorry.
I'd wave it at servicing. You know,
Yes.
I'd really automate as much as we possibly can from that offer to comp process, because I think we've done loads at the front end to make dip to app much better, but we've done next to nothing at the other end. You know, so maybe I'd wave the wand at free legal firms, who knows, but all of that bit I think is still really clunky.
Yeah.
And the industry I think needs to kind of focus on that now and go, what tech solutions can we get into that space to help all of us, frankly.
Brilliant answer. Thank
Is
you
that
for
right?
that. Yes, amazing. Thank you, Andy. That was fantastic.
Thank you.